Morning, Friday, September 23rd, 9:15 a.m. Market Analysis, Stan Ehrlich. We are falling apart, but there's some good things about that. The S&P 500 is well into new low ground for this last major leg down and equal to the two lowest closes back in the middle of June for the whole year and more, for the whole bear market. Oversold. One good thing. When you're oversold, you usually are close to a bullish turn, a turn back up again. Secondly, we are at pretty much our last vestige of support. The previous support level of 370.5 to 372, the red bar here didn't hold at all. It gapped below it, but now we have a gap to close. Remember, again and again I've said for the last several weeks, gaps are almost always closed. This has all of the earmarks of an exhaustion gap, which implies that it's the last gasp down, an exhaustion gap. Also, I mentioned we're near our support level. Excuse me. So that's a second reason to believe we are about to stop dropping. Current tick is 365.90-ish, hair below 366. Low and last almost, real time. So that's the second reason. Oversold, and there's a gap to close above the market. Thirdly, there is some of that support, so it's not much. I wished that we were trading at around 71, give or take a little, and not with a big, huge gap down and a big down day so far. But you can't turn the clock back. So I have oversold, I have a gap, and I have also the little bit of support that's left. And you can't rule out the lowest low for the whole darn trend, and that of course would be June 17th's low of 362.17. We're 66 right now, 10. So another 4 more points. We're down for the day already almost exactly 8 points, which is a pretty hefty down day to begin with. It's midway through the day or a little less. So we've got plenty of time to have a rally, and it still could easily be all the way back up to the highs of the morning so far and starting to close the gap or even more. We actually saw that kind of activity in the last week or two. It wouldn't surprise me, but it ain't happening yet. Don't get your buying shoes on yet, but at least get them close to your feet. Now, there are other reasons. We are getting very, very close to, and here's the 1 minute chart, by the way, on the spider. Almost low and last. 1 minute RSI, very oversold a couple of times this morning. Not in the last 10-20 minutes. No big deal, a little divergence possibly. The daily data chart on the DIA, the Dow Jones, is actually in new low ground for the year. Other than that difference from this S&P, we also have a downside gap, exhaustion gap. We're oversold for the second day in a row. There's no support anymore that's anywhere near close by. It's got to be a year or more away. Yeah, I got to go back into December of 20. So 2 years away, give or take. So that support is broken, but it's not the end of the day. If it closes back up above this green line, the previous lows in June, that'll look a little bit more friendly, especially the stronger it gets, the better it gets in terms of possible turning points. The QQQs are very similar on the daily vertical bar chart that the S&Ps, so they are, come on, getting closer to its lowest low 2 months ago, like a spider, and it has a significant amount of support in that same ballpark price range, unlike the spider. So that's a little bit helpful in terms of thinking that there is going to be an upturn very soon. I am saying maybe today, although you can't see it yet, but in the next couple of trading days. It's Friday. Maybe there'll be something that happens over the weekend that will cause the market to start to rally. We'll find out soon enough. Couple of corroborating factors here. Guess what? We're actually higher on the day in the bond futures. And look at the last 2 days. Yesterday we came down pretty substantially, broke the lows, continuing to make new lows to the trend down. And you know, as the bond futures go down, rates go up. And that's not good. It's inflationary, rates going higher. We all know that the Fed raised the rates 3/4 of a point 3 times in a row. Yikes. But it's going to stop someplace. Futures usually tell the story before it actually happens. That's why they call them futures markets. Anyway, we are now higher on the day. Not by much, 9/32 momentarily. But we're not, like you might think, a lot lower on the day because of the way the stock market's acting. Again, down 8 points exactly, 9.99 for a second there. 8 points down. So this, if it continues to rally, would help, I would think, the stock markets to come back up again. Also, oops, I did it again. Keep doing that bad habit. Some of the futures contracts, and particularly the energies. We have, where am I? Got it right there? Nope. Heating oil. 4 days ago we had a buy signal. We've caught the actual trigger point to go long. Very small loss momentarily. Make it full screen for you. But it's not a new low for the trend. It does have the possibility of a double or triple bottom. Triples are kind of rare. Double bottoms are a lot more common. But we have to start to rally here, and it's not yet. If the heating oil rallies, that's inflationary, it's not good, and we really don't want it, to be honest with you, to rally. I'd like to see this buy signal fail, lose a little money, make new lows to move down, and that's good news for the stock market. Energy prices going down. And it would be significant, very significant, because it would be a new low since April. Yeah, quite a few months. Crude, I was going to show you, and I can't find it yet, because it has already done the job. Here it is. Already done the job. The crude oil market has made new lows since February 25th. Currently trading actually below that date, closer to February 22nd. No big deal. So the point is, it looks like it's going to stay there. It looks like it is going to stay a new low close on a weekly, a daily, and a weekly, and a monthly basis. Normally, that's pretty bearish. The only minor problem is it's oversold today. But on a downside breakout, that's not particularly uncommon. You can bounce back up again to 80, 81, maybe even 82, and still turn around and come down. I remind you, a week and a half ago, I thought we had a low in place because it was oversold on September 8th. It did start to rally for a few days into some resistance, but it basically stopped, or it did stop, in the resistance area. And it has now proven to be a false rally, and we have new lows to the move, which again is supportive of a turn up if the heating oil, crude oil trend continues down, a turn up for the indexes. So that's two corroborating factors: interest rates, energies. One last one that doesn't quite match quite right yet. Next week is the last week in September, and we have the October lows coming up around the corner. The month of October is highly, historically likely to produce a low. I've done the research over 30, maybe even close to 40 years now, and approximately in the high 80s or very low 90 percentile, around 90, we have had a low during the month of September. It may have happened a day or two before September, a day or two after October, a day or two before October, a day or two after October, but the averages historically are definitely in the month of October, and it is exactly in month of October more often than not, and I'm showing you several months back. So I think the stock market has a very, very good chance every day that passes to have a turning point back up again. How far, how much? It depends upon the individual year's circumstance. So given the current situations, I think there's a good chance we could pop up easily back up above 400 again in a broad sense, starting in October, going into November, and then during November, ladies and gentlemen, I'll start talking about the Santa Claus rally. But let's see this October low kick in, and I will try to scream bloody murder if I think that it started the day that it is, whoops, I did it again, bad habit, the day that it started. Lastly, forex. Boy, oh boy, the euro dollar is getting pounded. We are now down to 0.79, almost exactly 0.791 to the US dollar. If you want to go to Europe, and I do, then we are getting really cheap. The lowest level for a few years, well, I can't even see the date. It's going to go back at least to 2014, 2013, maybe even earlier. That's a lot, a decade, let's say. Weekly, just a moment please. 50 years, I know it doesn't go back that far. Come on, what did I make? Oh, did I make a mistake? Yeah, I did. 30, sorry about this. Here we go. Wow, I didn't realize this. The euro is at the lowest low since, wow, okay, November of 2002. This is a 20-year new low for the last few weeks in the euro dollar. That is incredibly bearish. I don't know. It looks like this thing could actually get down to maybe 90 cents to the dollar. That'd be amazing. That'd be great. I'm going to buy my tickets pretty soon for next summer, maybe. That's it. I think, and I am still bearish, mind you. This is not changing the longer term picture in the stock market indexes. That has not changed. I think the S&P, say spring or summer, is going to be down to 340s, and that's my minimum, the low 340s downside objective, which I came up with back in January or February, somewhere in there of this year. No change of longer term opinion. We're almost down 9 points now, still sinking. That only makes me more conscious of a likely turn. Short term, few weeks, and if it includes the October low possibilities, then I would say for a month or two. And I'll leave you with that. Stan Ehrlich, Friday, September 23rd. Have a great trading day. Don't buy it quite yet, but get ready, get close. Have a great weekend.